Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here in the midst of Thirdly season. Hopefully we got a chance to see you all at one of the locations or virtually, if not. So diving into this week's Market Carver, we've got a couple of topics. We're going to talk about a potential change in quarterly reporting and what that might mean. And then Andrew's going to give us an update on breadth, something that we've just always at the top of our radar to see how that unfolds. So let's go into quarterly reporting here. And this is something that was floated in the first Trump administration, and he's resurfaced. And that is the idea that we move off of having companies report, which is an SEC requirement for public companies to report their earnings each and every quarter. And instead, the proposal would be to change that to just twice a year, make it semi-annual reporting. So there's positives and negatives to both of those. The positive is that you would free up a lot of corporate capacity rather than having to have so much focus on each and every quarter. It requires a lot of bandwidth to have to nail down those numbers and then hop on calls and report it. But more importantly, it adds a lot of focus and emphasis to the short term. A lot of the corporate C-suites should be focused on decisions that are going to guide them into the future, not necessarily make the quarters look good. The downsides and the negatives, the people who push back, are it takes away some transparency. And in a world where things are changing so rapidly, especially with AI, that in 6 months, a whole lot can change. So we'll see how that unfolds. In the UK is an interesting case study because they have went back and forth on this quarterly and semi-annual. They're now on the semi-annual wing. And one just interesting thing of note is that 90% of the companies still choose to do so on a quarterly basis. So that will be nothing to prevent companies from doing that if they so choose. But in the end, we hope there could be a lot of good that could come from focusing in on the long-term business plan as opposed to just hitting those quarterly numbers. So that is kind of the fundamental side. Andrew, I'll tee you up for the breadth.
All right, thank you, Adam. So the breadth chart I wanted to bring today, and as a reminder, when we discuss breadth, is just a fancy word for participation. When we look at the stock market, we often evaluate how the individual indices do, but we always want to know how are the majority of stocks that make up that index, how are they performing? And so if we zoom in on this chart, we've got 3 different pieces of data here. The first on the top is the S&P 500. In the middle is the percent of stocks that are within 20% of a new 52-week high. We've consistently been watching the index begin to climb higher, making its own new 52-week highs. So we want to know, are we starting to see a lot of stocks not necessarily having to hit a new high the same day, but are they at least within 20%? A pretty low threshold, in my opinion, of being kind of participating in that trend. Typically in strong uptrends, we see north of 80% of stocks. Good chunks of uptrends, we see most 80% of stocks are within 20%. This tells us that we still have some stocks that are declining, some are struggling, maybe they have some kind of fundamental issues or what have you, but at least 80% of stocks are at least within 20%. When we look at the current market, since coming out of the April decline, we haven't been able to breach 78% of stocks meeting that threshold. And this is in fact one of the longest periods we've gone. If we again look at that chart, we can see that during the tech wreck, we saw a very long stretch period of us not hitting 80%. During the financial crisis, we went a very long period. And then we'd have to go back to the 2022 bear market where we had something that exceeded our current level. So while we're having the market continue to hit new highs, we aren't seeing a massive, or at least a normal amount of strong participation there. This is again going to something we've talked about a lot throughout this year, is the heavy reliance on just those mega cap names. Things like whatever NVIDIA does is essentially what the market itself will do. If NVIDIA's up a lot, for example, one day, then more often than not, we're going to see the market reflect that strength, just because we're seeing so many just a handful of stocks that have such a massive weighting and control of the overall index. And so the market's able to kind of shrug off some of the weakness seen elsewhere. But this is something that creates a headwind catalyst. It doesn't actually mean it's a signal that we need to start acting upon, but it's telling us the environment the market's in, the fact that we're seeing leadership is starting to thin out. And this can go on for a long period of time. Again, it's not a signal we want to act on. It's just telling us that the market is a little bit more fragile than we like or traditionally see in strong uptrends. So we always want to know what the level of participation in a rising market is and understand, is the market on solid footing or is it becoming a little bit more fragile it is right now? And so we're always keeping track of how individual stocks are performing or struggling.
Great. Well put as always. So thank you, Andrew. And thank you to all of you for giving us this time. We sure do appreciate it. As always, if we can be of service, please don't hesitate to reach out. 800-928-4001 or scan the QR code and do so electronically. Thanks and have a great weekend.